After 2 years of investing in the stock market, I finally stopped investing in the S&P 500 ETF. And in this video, I'll tell you why and what I now invest in. Stay tuned. Hello and welcome to Diaspora Careers and Investments. If you are new on this channel, my name is Shadrach, and on this channel, I speak all about financial freedom, how to make money, and how to make your money work for you. For many investors, the S&P 500 is their go-to ETF or their go-to asset because it is passive and it's diversified. So that by investing a little money, say $100 or £100 in the S&P 500, they get their money spread across the top 500 companies in America. So with say $100, some of that is invested in IT companies like Microsoft, as well as even some transport companies like say Tesla or some pharmaceuticals like Johnson & Johnson. So the little money you invest in S&P 500 gives you exposure, gives you entry into several sectors, and that can be good. Here on my own channel, I've spoken highly of the S&P 500 ETF. But being based in America presents one problem, because if the American economy is suffering, that means that your portfolio would also suffer, and vice versa. If the American economy is doing well, then your S&P 500 ETF will also do well. Obviously, one way to deal with this will mean that you have to invest not just in America, but to look at other countries like Japan or Asia or UK or even Europe at large. And that will be one way to deal with that. But that is not the only problem with the S&P 500 ETF. You see, in the past 2 years that I've been investing in the S&P 500, I have come to understand that the average price for the S&P 500 ETF is under about £65, which means that if you buy your S&P 500 ETF for £65 and tomorrow it's selling for £67, you have made profit of £2 on each stock you bought. So that can be good for you. But the problem then is for the one who is now coming to buy. If you're coming to buy at 67, then it means that you would have to wait for the stock prices to go up before you make the margin, before you make the profit. Over the past years that I've been investing, I've always bought my S&P 500 stocks for under £65. But currently, the price is around $67 or £67, which means that I know that the price is a bit high at the moment. So what do you do? And there are two strategies to deal with this. First is to don't care and continue buying. And that is actually a viable strategy, what is known as dollar cost averaging. So what you do is that whether the price of the stocks are high or whether they are low, you keep buying, you keep buying. If it's high, you buy. If it's low, you buy. With the hope that by the time you are ready to sell, your average price of buying it will be lower than what you are selling. For example, if yesterday I bought it for 63, tomorrow I buy it for 65, the following day I buy it for 62. And by the time I want to sell, it's selling for say 65, the average of what I've bought is lower than what I are actually selling it for. So I make profit. So that can be a good strategy, especially if you cannot read the market, then that can be good. But I know that, this current hike in the price is almost artificial. That is not how the price, rises over time. And so my strategy now is actually to wait a bit out. For example, if something is always selling for 65 or 63, and all of a sudden it's selling for 67, I know that no, this is not natural. This is not organic growth. Rather, it is based on an artifact. Something has happened which has raised the prices. So as a business person, I can wait for the prices to drop and then I can buy more. And that is exactly what I'm doing now. Instead of still continuing to buy, I'm waiting out a bit until the price of the stocks actually come down to under £65, and then I would buy. Because although I'm not hoping to sell my stocks at the moment, I'll wait for about say 10 years before I sell my stocks. I know that instead of buying it for say £67 or £65, I could as well, wait out a bit until the prices drop a bit, and then I can buy a lot more with the hope that in the next 10 years, when the prices go up, I would have made the difference. If you're buying just a single stock, whether £65 or just a couple of stocks, 130 and 150, then maybe it doesn't really matter whether it's selling for 65 or 67. Maybe then it wouldn't really matter to you. But if you're to buy a lot of it, whether, 600 pounds and all of that, then maybe you want to wait out a bit until the prices drop and then you buy a lot more. Because by waiting, you could buy an extra stock with the change. So that may matter to you. But for me, I am waiting up for now until the prices drop a bit. So while waiting, what am I doing? Do I fold my arms and then, just stop investing altogether? Clearly not, if you know me a bit. So where am I now investing? And that is why I want to introduce you to the Vanguard Life Strategy Equity Funds. If you go onto your Vanguard website, there are some already prepared funds known as the Vanguard Life Strategy Equity Funds. And these are an already made portfolio by the Vanguard people. And it's a very diversified portfolio. In fact, there are several options. You can go for the Vanguard Life Strategy 20% Equity Fund, which means that only 20% of the money is invested in the stocks and shares, and the 80% are in government bonds. That's not something I really want to do because I want to invest in the stock market. So I would go for something with at least 80% equity, so that at least 80% of the money is invested in the stock market. So what I'm currently investing in is the Vanguard Life Strategy 100% Equity Fund, so that all the money is invested in the stock market. But unlike the S&P 500, in the Vanguard Life Strategy 100% Equity Fund, some of the money, in fact, only 15% of the money is invested in the S&P 500. And some is invested in the Asian market, some in the Japan market, some in the European market, and some in other portfolios. So in fact, with the same limited money, your money is giving you exposure into different countries and not an over-reliance on the American economy, which may or may not, perform very well in the next couple of years. So that is what you want to do. It's the same principle, but applied in a different way. You are still investing in a passive ETF as well as a diversified portfolio. But here it is not just diversified according to the sector, but it's also diversified according to the country. You are exposed not only to the American economy, but to the Japanese economy, to the European economy. And that is my strategy now. I'm not totally stopping the S&P 500, but I'm pausing for now until it drops a bit. And while doing that, I'm investing in the Vanguard Life Strategy 100% Equity Fund. And that is what you can do. And it's actually advisable to have multiple assets and not just rely on just one asset. Let me know in the comments section if you think this is a good strategy, or let me know what you are doing. How is your own portfolio performing? Do let me know in the comment section. If you are new on this channel, I'll be very grateful if you can consider subscribing. And until I see you in the next video, adios.